Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include summarizing the week that was in mortgage, my interview with Ardley's Nathan Denherter and Taylor Potter on borrower behavior and loan data from portfolios in the second quarter, and in the capital markets, there's no rate volatility, thankfully. Thanks to today's podcast sponsor, Total Expert, the purpose-built customer engagement platform trusted by hundreds of modern financial institutions. Total Expert turns customer data into actionable insights that help lenders engage and guide consumers through complex financial decisions. By fusing digital touchpoints and human interactions, Total Expert humanizes the customer journey to create better financial outcomes, build deeper relationships, and win customers for life. Visit TotalExpert.com to learn more. People gearing up for the Western Secondary in Southern California see that technology is on the agenda. Of course, it's always on the agenda, right? Do you know conferences have an LTV? That's lender to vendor ratio. Remember the good old days of Brexit, the US-China trade war? Well, now all the headlines seem to revolve around tariffs and the Fed. Quite a bit of uncertainty abounds in how much of the tariff impact is already baked into the economy and whether upcoming data, crucially on inflation and jobs, will confirm or challenge these concerns. The lackluster July employment report added to the unease, leaving open the question of whether we've seen a low point for payroll growth or if future deterioration is ahead. July's weak payrolls report has shifted the Fed's calculus from focusing on inflation toward prioritizing the employment mandate. Another worry is how will tariffs influence core goods inflation. The probability of a September rate cut is now effectively fully priced in, with attention turning to July's CPI, August non-farm payrolls, and August CPI as the pivotal data points for determining whether further cuts will follow in October or December. On the data front, we learned yesterday that Q2 productivity rose 2.4%, rebounding from the sharp first quarter decline, and helped slow unit labor cost growth to 1.6%, though productivity in the current cycle remains below its historical average. Labor market data were softer, with initial jobless claims ticking up to 226,000 and continuing claims climbing to their highest level since late 2021, reinforcing signs of cooling employment conditions following last week's payrolls report. Consumer credit growth in June was modest at $7.4 billion, driven entirely by non-revolving credit, while wholesale inventories inched up 0.1%. For today's interview, I want to welcome to the show Ardley's Nathan Denherter with a small feature from Taylor Potter, both discussing how borrower behavior and loan data from portfolios shifted in the second quarter. Ardley releases a quarterly portfolio analysis report representing an analysis of mortgage origination data derived from servicing portfolios and applications parsed and evaluated with the Ardley platform.
I do want to start, though, by talking about some of your mortgage market insights at Ardley, and specifically today, the second quarter 2025 portfolio analysis. Before we dive into specific stuff there, can you give a little background on the Ardley platform and why you engage in statistical analysis, the importance of it, and why it's a worthwhile endeavor?
Yeah, sure. Well, first of all, thanks for having me. I don't do a lot of these, so I really appreciate it. The Ardley platform is interesting, I think, for a couple of reasons. One, because we have about 5 million loans flowing through the system at any given point across all of our customers. So, it's not the entire mortgage industry, but I think it's a decent chunk we have some customers that are independent mortgage banks. We have some that are depositories, big institutions, smaller ones. And so, we really felt like we had a cross section to take a look at some of the interesting trends that might be going on in the market. And then, also, our customers span people that are very heavy on govies, very heavy on just conventional. So, we really think we have a pretty interesting look at what's going on. The second thing that we do in our platform that's maybe a little bit different than other people is when we do these analytics, what we're really doing is structuring each loan in a servicing portfolio as if a loan officer were actually doing that deal with a customer. And what do I mean by that? Well, one way you can go about looking at who's eligible for a loan would be to say, okay, well, the Freddie Mac 30-year fixed average is at 6% and this person's currently at 7%. So we should call them and try to see if we can work out a deal, with one of our loan officers. And that certainly that does happen out there. But what we do is a little bit different. We take the data in the servicing portfolio. And so now, the origination valuation, some of the origination credit details, how much is left on the loan. And what you can do is mimic what the loan officer would be doing with that borrower. So we use an AVM to try to figure out how much equity we think is in the property. We use real product and pricing from our customers' pricing sheet that morning to work out what that person product wise would be eligible for and what we think would be a good deal to put in front of them. And then we also add in taxes and insurance. We add in the fees that the lender charges. And so when we do this analysis, we're running down the entire portfolio, and then we're spitting out real deals that we think could be put in front of borrowers, and they'd be able to really get them. Now, obviously, there's some certain caveats to that. Like if somebody's lost their job yesterday or something, maybe this isn't going to work. But for the most part, that is not statistically not true of people when you talk to them over an average. So when you look at our aggregate statistics, what you're looking at is an analysis of what would happen if you were able to get all of your loan officers talking to all your borrowers at any given moment. And I think that's pretty interesting, in terms of being able to see what the outcomes might be. I mean, it doesn't mean that you'll be able to close all those loans, but it does mean you have a really clear picture of what eligibility and pricing and actual deals might be able to be done across your portfolio. And so when we do that, we don't know of anybody else that does that way. And so when we do this, that's really what we're trying to put out to show people, like, hey, there are some trends that you might be able to see in your portfolio that you might be missing. And the April boomlet that leads off this report is a really big part of that.
There's a couple different things I want to touch on there. General takeaways from the second quarter report, that's a good place to start, but also any shifts that we saw from the first quarter or from 2024, then kind of things that might have stuck out to you, here recently.
Yeah, definitely. Well, so the big thing that we saw over the course of the quarter was that for on average, and certainly for certain portfolios that we had, the eligibility for people to be able to do rate and term refis actually, in some cases doubled. And, that I think is noteworthy because there were a lot of loans that people could take advantage of. But in a case where there wasn't a big interest rate movement, or the share of your portfolio that can actually do a rate term refinance is fairly low compared to the overall portfolio, it might not be an area of focus for a servicing portfolio holder. And so, one of the big things that we really are trying to point out is the likely trend. At least nobody really knows what interest rates are going to do, but I think the likeliest scenario is that interest rates are going to be affected by changes at the Fed or other things that are telegraphed in advance. And so I don't know if I see dramatic shifts coming in the next, call it 12 months. But what we're trying to point out to people is there are moments where even a smaller shift can have a pretty big impact on the share of your portfolio that is able to do a rate term refinance. And those are easy loans to get. Those are easy loans to close. And, that over the last quarter here, that's what we were able to see with some of our customers. But the trick is you have to be able to do two things: identify those opportunities, and then also you have to get that offer in front of somebody pretty quickly. And so what we're trying to point out is, these opportunities are there if you're ready, but if it's not something that you're ready to act on, really quickly, then the opportunity might pass you by. And so I think the conventional wisdom out there is, well, the weighted average coupon on my portfolio is low. And so I'm not really going to worry about this, but I think what we're noticing is everybody really has two portfolios, all the stuff that was originated in the last 18 to 24 months, and then all the stuff that was originated in the COVID era. And the COVID era stuff, I get it, right? That's really low interest rate. And so those people, from what we can tell, seem to be really interested in home equity loans. But there is an increasing share of I mean, every day a new portfolio loan comes in. I mean, not literally every day, but that was originated at a higher interest rate. And those are ones that will be over the course of the next 12 to 18 months, really eligible for these. What we're able to see are little boomlets that people can take advantage of. And so I think that's a new scenario, at least in terms of my time in the mortgage industry. I remember lots of refi booms where there's a secular trend of downward pressure on interest rates, and lots and lots and lots of people are able to refinance, either get cash out and lower their payment or just do a rate term refinance, over the course of a long period of time. But we're thinking about it more like there'll be very specific moments in time in the future where you can take advantage of that, and then they'll go away. So that's what we're seeing, I think, trend wise.
Yeah, the emphasis on getting the borrower at the right moment really stuck out to me, and I don't want to gloss over that point too much. If we could talk why, in this era of speed and precision, staying on top of these minor movements, your platform is designed to kind of surface the movements at, the moment they emerge, if you will. And maybe I butchered the tagline there, but if you could explain
I thought
why
that was great.
you're well positioned for this, that would be helpful.
Yeah, well, I think that's a really big point. I've done a lot of analytics in my career, and I've always felt that analytics are great, but there's always a challenge, at least in my experience, getting some good analytics in the hands of a decision maker who can execute and really take advantage of a situation that you've uncovered. And so one of the things that we try to advise people, or certainly our customers, would be to monitor your portfolio on a continuous basis. And then when you see an opportunity to get some of these loans in front of people, you should take it, either using that as part of an outbound calling campaign, or using it in some other marketing channel, email or SMS or whatever the case may be. There's a moment where if you get this loan in front of this borrower, you're able to capitalize on that opportunity. But if you're not able to do that, then that it's very likely that that'll dry up. And that, I think, that differs from some of the other times that I've seen in my career in this industry, when if there's going to be a long-term downward pressure on interest rates, you could have an attitude where you'd say, well, if we don't get them this quarter, we'll get them next quarter, because interest rates are just marching lower, over time. And it doesn't seem to me that that's the most likely scenario. It doesn't show up in the numbers the way that I'm looking at them. And so positioning yourself to be able to take advantage of these moments, I think is critically important. And that's really what we work on full time over here.
Versus the first quarter, mortgage rates in portfolios dropped, which I guess you would say that's the function of people refinancing. The average age of loans went up, though, over a year versus the first quarter. So maybe people aren't refinancing at the same rate. I'm going to ask you to kind of break these down. We saw home values decline by nearly 26,000 versus the first quarter. And maybe, once again, that's a refunction of you refinance to a lower place. I don't know. And also we saw loan to values drop to below 50% in the second quarter. They were above in the first quarter. Kind of any meaningful things there you're seeing in the data, or maybe walk us through how I incorrectly explained why those things are happening. That'd be helpful.
We are looking at the same portfolios quarter over quarter. There's really a strong distinction in like Nate said, a tale of two portfolios, where the COVID era borrowers are taking more equity out of their homes, and we're seeing that continue. In Q1, I think the average equity application was about $60,000, and in Q2 it was $70,000. And you're looking roughly at the same number of applications. So we're seeing the amount of equity that borrowers are asking for increase. While at the same time, the borrowers that do have the, opportunities for rate and term, we're seeing them react really quickly. And what it means is if you don't have a equity product or you're not currently offering a strong equity product, you're really missing out on opportunities for applications in this rate environment. Because when we look at, we have an interesting view of first and second liens combined. And so I think it was about 94% of all applications in Q2 were equity applications. And that is split between cash out first and either HELOC or HELOAN as a closed-end second. But those really are driving applications right now. And so it's important that lenders have the ability to offer both those products, offer them side by side in a way that borrowers are able to utilize their equity in a product that makes the most sense for them.
I want to talk about what this means for future refi boom lits, as you called it. Everyone thought last year when the Fed lowered rates almost for the first time almost a year ago, last September.
Sure.
Well, the refi wave is on. It turned out as like a 2-day boomlet sort of thing. What does that say for the way you think future opportunities of refinance will kind of take shape? Do you think it's that borrowers will be very in tune and any micro movements will spur some activity? What do you think what we've seen here from the data says about what we'll see for future refi movements?
Yeah, I think that's a good question for someone who works on our platform. We really don't think that borrowers will be positioned to take advantage of boomlets by themselves. And why do I say that? Well, Robbie, I know you think a lot about mortgage rates, and so do I, right? This is what we do, but normal people don't recognize boomlets for what they are. I mean, I think by the time there's a moment when interest rates can move enough to help a borrower, the way that they might notice that would be in an article or something that pops up in their news feed. And by the time they see it in their news feed, someone's written about it. That opportunity may or may not be there for them. It's certainly, people have regular lives and actual things to do. And so by the time they get around to reaching out to maybe the mortgage broker or loan officer that they've worked in the past, that opportunity could have passed. And so the way we think about things, you need to be a little more proactive than that and be able to communicate on a more consistent basis with your borrowers and let them know, hey, number one, we're monitoring this for you. And number two, we're going to tell you when we think the time is right for you to take advantage of this. And we've done the math and we can figure out that, that the payback period on this is X years. And so this is a good deal. And so, I think it comes down to when you think about having those loan officer conversations manually, right? Like actually doing all that, I think it becomes a labor problem. I mean, how can you take advantage of a boomlet that's only going to last a month or 3 weeks, with people on the phone? Well, I think it's going to be tough. I think you're going to have to find a better channel to communicate. Number one, very personalized information to a borrower, letting them know that you've got their loan in mind. And yeah, we really think this is worth your time to go through the process. And number two, we've done this specifically for you. And so those are the keys that we see in our data when it comes to, we're able to find, a surge in the eligibility for any particular segment of a portfolio, are able to take advantage and then turn those into loan applications. And so that's, to us, that's the name of the game of protecting your portfolio going forward for the next, who knows, 12, 18 months. Anything can happen. Certainly rates can shift, but it seems to me like the most likely scenario is there will be just very specific moments in time that you can take advantage of this, and then that'll go away again.
I really appreciate having you on. So looking forward to future discussions about data and stuff like that on this podcast. Thank you.
Yeah, likewise, Robbie. Thanks a lot.
Mortgage prices are a direct result of supply and demand, and the agencies released fairly uneventful July prepayment reports late yesterday. Fannie 30s and 15s increased at a slightly lower 4% and 6% on average versus June, while Ginnie 2s were up 3%. Paydowns totaled $87.4 billion versus $84.0 billion in the prior month, while net issuance was $15.1 billion versus $24.0 billion previously. As expected, Freddie Mac reported declines in the 30-year and 15-year mortgage rates in the week ending August 7th, with the 30-year decreasing 9 basis points to 6.63%, just 1 basis point above April's year-to-date low, while the 15-year fell 10 basis points to a new 2025 low of 5.75%. Today has all the hallmarks of being a pretty dull summer Friday trading session. There are no major economic releases. The same goes for Monday, while the only event is St. Louis Fed President Muslim delivering remarks. Markets will digest the announcement that President Trump has selected Dr. Stephen Moran to the Board of Governors until January 2026. Moran was serving as chair of the Council of Economic Advisors for Trump. We begin Friday with agency MBS prices roughly unchanged from Thursday's close, the 2-year yielding 3.73 and the 10-year yielding 4.26 after closing yesterday at 4.24%. Let's wrap up with a joke and some housekeeping. In filling out an application where it says, in case of emergency, notify, I always put, doctor. Thanks again to Total Expert, the purpose-built customer engagement platform trusted by hundreds of modern financial institutions. Total Expert turns customer data into actionable insights to help lenders engage and guide consumers through complex financial decisions. To learn more, visit totalexpert.com.